This video will provide some guidance on how to approach a consolidation question where there was intragroup sale of inventories. If you had intragroup sale of inventories during a reporting period, you will always have to eliminate the total sales and the total purchases. This needs to happen to ensure that in the consolidated statement of profit and loss, the revenue line item and the cost of sales line item represents transactions with parties outside the group. Then you have to determine whether there's any intragroup inventories still on hand in the buying entity at year end. If there's no inventories on hand, there's no unrealized profit to eliminate. That means that the inventories were sold inside the group and then sold by the buying entity to a party outside the group. So the full profit made intragroup realized in the same reporting period. If there's intragroup inventories still on hand, you definitely have an unrealized profit that you have to eliminate. Guidance on how to calculate this portion of profit that you have to eliminate is as follows. If you have inventories on hand in the buying entity's TB, that rand amount represents the cost price for the buying entity and the selling price for the selling entity. So to get to the gross profit included in that carrying amount of the inventories, you need to apply the selling entity's gross profit percentage or markup percentage. That will give you the portion of the unrealized profit. When you do these calculations, it's important to remember the difference between working with a gross profit percentage versus a percentage markup on cost. Let's briefly revise that principle. If I give you the gross profit percentage of the selling entity, the ratio between selling price, cost price, and gross profit is 100% selling price, 80% cost price, 20% gross profit. If you're then using the inventories on hand representing the selling price and you want to get to the gross profit included there, you will multiply that by 20 over 100 to give you the unrealized profit portion. If I've given you that the selling entity made a markup of 20% on cost, your ratios are different. Then selling price represents 120, cost price 100, and gross profit 20. To now derive at the unrealized profit included in that inventories amount, representing the selling price for the seller, you have to multiply by 20 over 120. If you had unrealized profit in closing inventories at the end of the first year or year one, that would represent unrealized profit in opening inventories in year two. So that would give you then an indication that you have a profit that was made in year one that has to realize in year two through the consolidation journal entry where you debit retained earnings opening balance and credit cost of sales.